Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. On the podcast this week, my first call was to Nick Brind, who is the co-portfolio manager of Polar Capital Global Financials Trust, ticker PCFT, which has been around since 2013 and is coming up to an interesting point in its ongoing corporate history. It has a market cap of around, I think, 630 million, something like that, so a significant sized trust, and the only one of its kind in the investment trust sector. So, Nick, I'm going to start off by actually asking you to go back 5 years. You do have a significant event coming up, the 5-yearly tender offer, when shareholders in the trust will have the opportunity, if they so wish, to tender their shares. Up to 100% of the share register could do so. I'm sure you're hoping or expecting they're not going to do that. But back in 2020, when you had your initial, what was then a 7-yearly tender offer or redemption opportunity, it was right in the middle almost of the COVID pandemic. And nobody loved financials at all at that stage. And I think you lost about 40% of the share capital at that point, which reduced your size significantly. But since then, it's been pretty good sailing, I'd say, for the trust. Financials have recovered, and the trust has obviously grown, as I've indicated. So what's your feeling about the sector now as we come up to this latest tender offer, which we can talk about in a bit more detail in a moment?
Hi, Jonathan. Thank you very much for having me. I'm delighted to be here. There's extraordinary time. I mean, it was a existential crisis, obviously, at the time, 1 in 100-year pandemic. The trust shrank from over 300 million of assets at the end of 2019 down to 100 post that tender, which took about, as you said, 40% of shareholders elected to take cash. And that was done, from memory, around £1 a share or thereabouts. So times change. Financials became the recovery play, reopening trade in 2020, post the news that Pfizer had produced a vaccine. And you saw a significant rotation back into the sector at the time. And then the tailwind on top of that was the change in interest rate environment, which has changed the profitability of parts of the sector markedly. So day and night to when you look at certain segments which we can drill into. And it's been a terrific place to be. So 5 years on, financials have returned about 125%, materially outperformed wider equity markets. And glad to say shareholders who've backed us over that period are sitting on some good gains.
So that's all been very positive, and obviously it makes for a much more positive backcloth to this particular tender offer than you had last time in 2020, as we've said. It might be worth also going back a little bit, back to the foundation of the trust, which was, I think, 2013. And the idea behind the trust then was that banks had taken a horrible beating in the global financial crisis. Nobody wanted to own them. And then the government policy that followed that, tighter regulations on banks in particular, plus move towards zero interest rates, it couldn't have been a worse combination of factors, essentially, for banks and other types of financials. But now, with longer-term interest rates rising as well, and obviously significantly higher than they were back then, where do you think we are in the interest rate cycle, and how would you break down what's actually been happening to interest rates and why the yield curve in particular has moved the way it has?
That's a very fair question. So going back to the original launch in 2013, the trust was launched as a low-risk way to play that recovery in global financials. We were early with hindsight. And to your point, you still had some significant headwinds at that time around regulation, capital requirements, and then the nail in the coffin was zero and negative interest rates. We knew then, but we couldn't prove it. We now know in hindsight that was an extraordinary period of monetary policy. We don't think we're going back to those kind of levels for reasons I'm sure many of your guests have talked about in the past: reshoring, geopolitics, demographics, and so forth. And therefore, if we're right in that belief that the new range for interest rates is maybe a low at around 2% and a higher 4 and 5, with all the caveats any forecasts have, then that's a great environment for the sector. Drilling down, banks make money, difference between what they charge on their loans and mortgages versus what they have to pay out on their deposits, so they can make a good return. Similarly, insurance companies, they make money two ways. Underwriting profits, so as long as they're taking more premiums than they're paying out in claims, and we've seen that improve, that's a separate discussion. But also the float, to use Buffett's quote about the money sat there to pay claims that sat largely in cash and short-term bonds, and the returns on that's gone up. So again, insurance companies are benefiting, and likewise many diversified financials, sat there with cash on their balance sheet. So that's a great background. Where do we think we are today? We are obviously, as a function of the noise coming out of the White House, looking at a slowdown of some sort. That will take a little bit of time to play out once we get an idea of how long the discussions around tariffs and how they play out and how quickly they play out. And that's likely going to lead to lower rates from here. And in the background against inflation that's been moderating, slightly softer employment data, commodity prices equally have been weak, as a positive. And the sort of after effects of the spike of inflation post the pandemic dissipating, then central banks have room to cut, maybe less so in the US because of the function of the tariffs they've put on. But that gives central banks room to cut a little bit. But we don't see rates going back to levels that they were a few years ago. The big shift in the last 15 years is household and corporate balance sheets have seen a significant strengthening. And as a result, they're actually in good shape. And I think one of the key takeaways for us in the last few years is if you'd said to someone, you're going to have a 1 in 100 year pandemic, you're going to see inflation spike over 10%, unemployment go briefly to double-digit levels, you're going to see interest rates go up 5 percentage points, there'll be a war in Europe, and you'd see barely any deterioration in asset quality or bad debts on banks' balance sheets. And that's quite an extraordinary result. That, we think, reflects, understandably, banks have been forced and their own risk appetite to clean up their act. More of that risk has shifted off balance sheets. Today, the financial system's got a lot more capital, a lot more liquidity. As we know, it's much more regulated. And consequently, it's shown to be incredibly robust. So interesting times, but we think it's in a good place.
So there's quite a few things to unpick there. Let's start with one in particular, just the last point about banks. Banks have performed very well. Say when I refer back to this conversation we had back in 2020, Lloyd's was trading at 25p or something, and it's now about 70p, something like that. So it's gone up nearly 3 times, that kind of thing. And obviously banks globally done as well. But the bank weighting in your portfolio has declined, I think, from where it was then, a little bit anyway. So what was the thinking behind that? How does the movement in the bank's share of your portfolio reflect your thinking? What thinking does it reflect, I should say?
Yes. So we've taken, in the last 18 months or so, a much more active view of how we're positioning the trust portfolio. With that, we've seen quite a material reduction in banks. Offsetting that, we've increased our exposure to the diversified financial space. The reason is twofold. One is some of the banks are great businesses. We like them at the moment, and we want them in the portfolio. But there's others that we don't want to own them for the sake of owning banks, just because we're a specialist focused fund on the sector. If we can find better returns elsewhere, then we want to lean into those. And that's part of the reason why we've rotated the portfolio. If we see an opportunity, let's say, and there's a sell-off or a downturn or something, or there's a fatter pitch, then we're more than happy to take our banks weighting up from the levels it is today to take advantage of that. But it's just being conscious of, we can sit here and complain that people don't understand why banks are so cheap and they should be higher, but we've ultimately got to be conscious of how the market views them and be more active around that decision, how to position.
As you say, the biggest sort of change in the portfolio makeup, as I look at it, is this increase in diversified financials. What exactly does that cover? What are we talking about here? And what are the kinds of businesses you're adding to here?
Yeah, so just taking a step back, financials are the second largest sector globally. The big banks do make up the largest subsector of that, about 40%, and we're around 35%, followed by diversified financials and insurance. Diversified financials, it's a broad spectrum of businesses. It's stock exchanges, it's asset managers, it's some of the consumer finance companies. Depending whether you split them out or not, it will include payment companies such as MasterCard and Visa. In our presentations, we tend to put that in a separate bucket to distinguish it. You'll have some of the trust banks, custody banks in there, and some of the retail brokerages and things like that. So quite a mixed spectrum of businesses.
So when I take you back to 5 years ago, though, you were also talking quite a lot then about fintech. Does fintech sit in Diversified Financials? And if so, you don't seem to be talking about it separately at the moment. Is that still an exciting area, or is it one that has not quite fulfilled its expectations?
It is an exciting area. I think there was a lot of froth if we go back 3 or 4 years ago. Quite a few fintech companies IPO'd on the market, offering incredibly rich valuations, claiming that they were going to materially disrupt the incumbents. Some of these businesses are really good. There's others that are still unquoted, that are talked about a lot, that have built great business models. But we found better value elsewhere in the listed space, where the risk rewards looked more attractive. And that's proven to be the case. As we sort of say, growth investors, they put a premium on promises, and for value investors, you put a discount on reality, and financials are the biggest value sector. So we haven't seen an attractive enough risk reward to lean into many of the listed fintech companies. We do have some exposure. We have a couple of unlisteds in the portfolio, Moneybox and Atom Bank. But ultimately, if we wanted to take advantage of some of the fintech opportunities, as you know well, there's a number of listed investment companies out there trading at quite large discounts, and that might be a better way of accessing that sector right here and now.
You mentioned in passing the Trump administration, and just looking at the share price performance of the trust, it obviously you've been affected by the fallout from that, or the yo-yoing, I should say, perhaps, of sentiment in response to what Trump has been proposing. Are there any positives in what he's been trying to do as far as the kind of things you're investing in are concerned? I'm thinking obviously in particular about deregulation, whether there's actually any scope there for financials to benefit from some kind of deregulation. And there has been talk of loosening regulation on banks in America and over here. How significant could that be?
Yes, it's potentially material. In the short term, we've got to get past the noise of the tariffs and the impact on wider economies. But yeah, there's definitely a push to change the sort of regulatory background in the US, but not only the US, we can come on to the UK and Europe as well. And he's effectively taken the same playbook under his first administration. Under Trump 1.0, he replaced the heads of the regulatory agencies in the US. And then they set the tone for how they would conduct their affairs. And when you speak to most management teams, they support the tightening in regulations. What the frustration has been in recent years is the answer to every issue from the regulators is more capital and another 5,000 pages of rules, regulations, processes, and et cetera, and what comes with that. To give a good example, so what they call the Basel Endgame. So this is the series of rules, capital requirements that have been put in place post the global financial crisis to say how much capital does the banking sector need. And the Basel Endgame was effectively the tying up of all those rules. And middle of last year, the Federal Reserve put forward a proposal that US banks would need a further 15% increase in capital. And for JP Morgan, that was going to be 25%. And quite significant pushback, not just from politicians on both sides of the aisle, but even from some regulators going, well, this pendulum has swung so far from where it was pre-2007, this is not going to be good for the financial system and therefore underlying growth. JP Morgan, that relatively sailed through the financial crisis, needing a much bigger increase as well. So there was significant pushback. There was talk about watering that down to about 9% towards the end of last year. And now with the Trump administration coming in, effectively, they think a line will be drawn through that. So that's one major step. But there's also talk of what's called the supplementary leverage ratio. So this is a pure leverage ratio, equity to assets. So the binding constraint for some of the large US banks is not how many risky loans they have on the balance sheet, it's just the amount of assets. So they get penalized for holding US treasuries. So there's talk about perhaps looking to amend that rule, etc., which would obviously be helpful for when there's volatility in markets. So those are a number of steps, and potentially that will be positive for sentiment and really putting a nail in, finally saying this is it. This is the regulatory framework. You can now move on and manage your business without expecting yet further changes. So that could be a big positive. And even latterly in the UK and Europe, policymakers are now waking up and going, well, actually, maybe the answer to growth isn't always more regulation. We've seen in the UK, the Financial Ombudsman Service has been forced to reduce the fees that it charges financial companies for claims, many which have been frivolous from claims management companies. There's obviously, in Europe, we've seen the removal of the debt brake. So a significant event and what implications that will have. And there's also talk about reviving the EU Capital Markets Union and the Savings and Investment Union. So there's a lot of thought going into what can be done to try and facilitate growth. We all need more growth. How can policymakers shift the regulatory guardrails to facilitate that?
Yes, well, I guess history relates that it tends to be too much in one direction at some point. Everything is always carried to excess, and we always wonder about that. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. If I look at the global financial system overall, a lot of people would say that there's still plenty of risk in there. We've managed to clamp down heavily on the risk from the banking sector, but there's lots of other risk out there from alternative financial providers, if you like, or other elements of the financial system, in particular use of private credit and hedge funds and people getting involved increasingly in doing what banks used to do. Do you have a view on whether that overall balance is still favourable? In other words, if the regulatory tightrope on banks has reached its nadir, shall we say, and may go back, there's still a lot of risk out there, is there not? There's a lot of debt out there, there's a lot of financial gearing out there, and so on.
Yes, I think that's a fair question. Ultimately, no one's talking about reducing capital requirements in the banking system. I think we have to note that. And yes, that risk has shifted away from banks into non-banks, maybe into some insurance company balance sheets. You've got to look at that quite carefully. Now, there's a lot of nonsense written about the alternative asset management industry, private equity, private credit. I think the fair criticism is there's leverage there. You are taking greater risk if you're putting money into private equity. There's questions about marking to market, the volatility laundering, as it's been called. But ultimately, here's an industry that has delivered good returns to its investors, its LPs. Yes, there'll always people who push the boundary of risk, make bad investments, but that's no different if you owned a listed bond or a listed public equity. It doesn't mean the whole industry is at fault for taking too much risk or doing anything. So that's something regulators should always keep an eye on. Where does risk go within the system? But that's been a great opportunity for the sector. We've had exposure here to the likes of KKR, Blackstone, and others, Ares Management. We did reduce our exposure quite materially at the back end of last year because the share prices of these businesses have done so well. And those cyclical risks are there, and people forget, in a downturn, if you're exposed to private equity, then you're going to have to take some markdowns on those investments. And that, as we all know, is reflected in some of the discounts you've seen in the investment trust sector on those trusts that focus in that area. But there is this big shift, and that's a separate question for a conversation another day. Why is so much money moving out of public markets into private markets? Has the burden of reporting and disclosure moved too far for public markets, which is causing this money to move away, and the impact that has on people's ability to save and invest? But I think underlying it, the issue in markets today is probably one around government balance sheets, fiscal deficit.
Yes. We haven't talked about that yet. Exactly, yes. You said other balance sheets are in good order, but the government balance sheets are definitely not in good order. And that would lead one to think one of two things: either that interest rates are going to stay much higher than they have their government debt, at least, or that there is maybe some crunch coming in that area. Where would you sit on that spectrum?
Yeah, I think these things can go on for a lot longer than you expect them to. I think it's telling that when there was a bit of volatility in the US Treasury market, it didn't take long for US Treasury Secretary to get hold of Mr. Trump's Twitter feed, persuade him to put something out, and then walk out onto the White House lawn and say, we're pulling back on these tariffs. And I think ultimately how it ends is impossible to know. But you can't allow these things to get out of hand, as we've seen, in the UK 2.5 years ago, and more recently back in April. And whether that is forced upon governments sooner rather than later, we'll have to wait and see. But I suspect in the short term, it will go on for a lot longer than most people expect.
So we talked about the fact that the performance of the trust has been very good. Financials generally have outperformed the market over the last 5 years or so. So that might lead one to think that the kind of things you're investing in are now become quite expensive. Is that the case?
It's the opposite, actually. Notwithstanding, the sector's performed very well. Valuations have risen. But today, the sector's trading on around a 12 times P multiple. If you stripped out MasterCard and Visa and friends in the payment sector that rejoined financials about 2 years ago, then it's more like 11 times. And that's around not far off a 30% discount to the market. Now, when we launched the trust back in 2013, we thought it was cheap on a 15% discount. Today, it's on close to 30, and the earnings of the sector have actually grown faster than the wider market over those 12 years. So the only reason it's underperformed over that period, and not by a huge amount, is because it's actually derated relative to the wider market. So actually, in relation to where other sectors are trading, it still looks very good value. Parts of it remain very, very cheap, parts of it less so. There's definitely growth elements within the sector. Some of the exchanges, some of the data service providers like S&P and MSCI and companies like that. But there's still a lot of value.
Right. I mean, obviously, one of the factors behind that is another sector of the market which has been very richly valued, shall we say, and dominated the performance. That's obviously the big tech and related things. So, in relative terms, that might be right. But what you're saying is, in absolute terms as well, you think that there is value there.
Yes, I think undoubtedly there's parts of the financial sector towards the top end of their historic trading range. There's other parts that still are trading at multiples below where they have been historically. I mean, European banks would be a classic example of that. And wider banks as a generalization, I mean, they're on a 40% discount to the market. And they've been on much, much tighter. Now, obviously, the flip side is maybe that's market multiples compressing at some point, and maybe valuations of financials don't rise. But the attraction to us at the moment, when the call you've had to make over the last 15 or so years is if you've been long US, and particularly long US tech and long the Mag 7, you could have made a lot of mistakes. Going forward, do you see that degree of outperformance that we've had in the last 10 plus years? People got to think a little bit more about the asset allocation. And it's been an easy call to be underweight global financials. But as the second largest sector, we'd say that call's much more difficult to make going forward. And it's a bigger risk for institutional investors to be underweight such a large component of global equity markets.
I think you can see where I'm going with this. I'm interested in how you're basically pitching your story to shareholders as you're talking to them about what's the case for investing in now or for not tendering now, I guess is the way to put it. Before perhaps I get you to answer that directly, it might be worth just reviewing the kind of changes that the board has made in terms of the proposition that you're putting to shareholders now. You're coming up to this 5-yearly tender offer, and there's going to be another one in 5 years. It is 100% tender, so you could, in theory, lose all the money. But there are some other little changes that are being made in terms of fees and so on, and most particularly interesting one in dividend policy. Perhaps you could just go through those and explain what is different about the features of the trust, if you like, as you come up to this vote that you're proposing to change, and why.
So the 100% 5-yearly tender offer at close to NAV remains. For us, that's very transparent. We're treating shareholders in a way I would like to be treated. We have to perform. We have to repitch the investment story every 5 years. We're not holding on to their capital. And it's the ultimate discount control mechanism. The mandate remains the same, global financials. The fee is a flat fee today. That is being changed to a tiered fee, of which half will be charged on the layer of market cap and NAV. So if the trust trades at a discount, then we will see lower fees. So it aligns us more with shareholders. The performance fee is being removed. And then we're putting in this 4% sort of enhanced dividend policy. So today the dividend is around 2% and change. That increased to 4%. Where it's not met out of revenue, it will be paid out of capital. Two sort of takeaways from that is one, when you look at the underlying cash yield on the sector, if you add back in buybacks, then the underlying yield on financials is probably north of 5%. So paying a 4% seems to us still a conservative number to pay out. Secondly, it frees us up as managers to focus entirely on total return. So we've always had an element of the portfolio that's tilted towards income because of the income and growth mandate. We've had a fixed income bucket in there. That going forward will be tactical rather than needing to have some to generate some of the yield. And hopefully that will lead through to better performance as well. So that's important. And then there's a new discount policy put in that, around a 5% discount, we're using a sort of 3-month moving average, the board would step in and buy back shares with the aim of getting the discount back below 5%. So those are the significant changes.
Well, they add up certainly to a more pro-shareholder kind of approach, I guess. So that's part of the proposition, is that it's become a more attractive vehicle as well as being an attractive sector. So what are the risks, though? What are you saying about the risks of this whole package that you're now offering shareholders?
Well, ultimately, we're a sector-focused fund. The performance will live and die by the performance of financials and how we manage that opportunity set. I mean, for us, it's been the most unloved sector for most of the last 15 years. It remains the biggest value sector in the market. And when we go back, and we know 2000 was a bubble in technology and a sort of anti-bubble in value, and then we had the opposite again in 2007 and 8, where value sectors got up to the same level that the growth sectors got up to in 2000. And all we're saying is there's a piece of elastic there today. The growth sectors, technology, communications, healthcare, represent north of 40%. And we're not saying that they don't continue to perform, but when sectors and individual companies come to dominate equity markets, history's shown they struggle to continue to outperform. And financials are likely to be one of the biggest beneficiaries of any of that rotation. Now, we don't need the rotation to happen. There's great tailwinds around democratization investing, these retail platforms. Today I can pick up my mobile now, obviously with permission from my compliance team, and I can buy any stock, I can short coffee or cocoa or whatever it is. You're seeing the participation of retail investors increase significantly over recent years. You've got a different investment background with higher interest rates, which means the sector is more profitable. You've got these regulatory tailwinds, having had 15 years of regulatory headwinds. You got some themes around insurance and emerging markets, potentially long-term growth of the middle class in emerging markets and therefore demand for financial services. So that's the opportunity set. The risks, undoubtedly, it is a cyclical sector. So if we see a sharper impact from tariffs or something in the future, you would normally expect to see the sector underperform against that background. We'd hopefully position the portfolio otherwise. Financials, the surprise is they've outperformed year to date and have continued to outperform despite that volatility and despite the sunlit uplands of capital markets reopening and all the hope from obviously the incoming Trump administration. But yes, for us, it's day and night in regards to the fundamentals of the sector, but you can't escape the macro background, and that's probably the biggest risk.
And then just on the investment trust structure, as it were, obviously by adopting this new enhanced dividend policy and the discount control policy, you're hoping to eliminate discount risk for those who invest in the trust. You've got a significant weighting of wealth managers on your share register. Are you consciously trying to attract different sources of demand as well, including retail investors and perhaps potentially pension funds who haven't really looked at investment trusts in this way? Is that part of what you're trying to do here? Or is it just a question of making it an even more attractive vehicle for those wealth manager shareholders?
It's a good question. It's twofold. And the proposals we put forward, we hope, makes it a better mousetrap for those wanting to get exposure to global financials. We've made a lot of effort to increase dialogue and go to conference presentations with some of the retail platforms. So that's a regular thing that happens, not just with this trust, but obviously the other two Polar Capital trusts, which you know well, and garner that interest. That's a long-term process. And we're seeing that going in the right direction, but we have to do more work, as many of our peer group, I suspect, do as well.
What I'm thinking here is that you also obviously have an open-ended fund, and I think you have two open-ended funds, or at least you used to have, which one was more focused on growth and one was more focused on income, that sort of different investment clientele. I was just wondering how the investment trust fits in that overall offering that you have.
So today we've got two funds. So we have the trust and then we have a financial credit fund. So very much the opposite end of the risk scale. It's investing mostly in senior and tier two, but also some other subordinated banks and insurance bonds. At some point, hopefully over the next year or so, we'll look at relaunching an open-ended fund, which will give similar, hopefully, characteristics, or that's open for discussion, or a similar way of getting exposure to the sector through an open-ended vehicle.
That will be interesting too. Okay, well, Nick, thank you very much for talking to us. It's been very interesting. I guess the only other question I could ask is, well, there are many other questions I could ask, but this one relating to the investment trust. Why has nobody else tried to do this if you've been very successful with this strategy? You don't have any competitors at the moment.
No, I mean, I suppose the nice thing is we're unique in that. When you look at the open-ended peer group, a number of them have closed their open-ended funds. JP Morgan used to have one. Aptus have closed theirs. The ETFs out there, they're focused on the MSCI World Financials Index. So we give you exposure to emerging markets. But you've obviously got regional financial ETFs that people can get exposure to. But yeah, for a plain vanilla equity offering, it's quite difficult, I suspect, to get that sufficient size to launch a new vehicle. I don't know if people have tried, but
I mean, there are obviously always competitors in new types of product, ETFs in particular. You know, your trust, I think, has performed pretty much in line with your benchmark over that period. It's been positive, in line with the benchmark. So you would think there might be an ETF that you could use that would do the same thing without any significant discount risk.
yes, ultimately, we've got to be relevant to investors. We've got to outperform. We are offering something slightly different from the ETF offerings there, the emerging market exposure. We have some exposure to unquoted, the ability to use leverage. But ultimately, we've got to deliver. And if we deliver, then we're relevant and we'll attract money and vice versa.
Just on that final point of gearing, I mean, you haven't used gearing very much, or at least you're not using much at the moment, as far as I'm aware. I see it's about 2% or something. Can you remind us when you would use extra gearing and what would your thinking be around that? When would you want to use it, or when have you used it?
So gearing has ranged from 0 to just shy of 14%, the life of the trust. Got up to that 14% in 2020 during the pandemic. So when share prices fell, we thought valuations didn't reflect the underlying fundamentals and took advantage of that opportunity. More recently, with markets having done very well, we've allowed gearing to come down a little towards the low end. Right now, we've got the tender offer coming up in 2 or 3 weeks. So we've just pared it back in light of that. But if we saw a correction where we felt share prices fell to levels where the risk reward was more attractive in absolute terms, then we'd use the opportunity to take gearing up at that point.
So on that note, that brings us to the end of our conversation. Thank you very much, Nick, for your time. That was Nick Brind, the co-portfolio manager of Polar Capital Global Financials Trust, ticker PCFT, with its tender offer coming up before the end of June.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.